Well, natural gas is giving back some of the gains that we saw yesterday. It has been stuck in the situation of ever-rising stockpiles. Yesterday, though, we got a potential supply shock in Australia, a work disruption that could disrupt global supplies. Now, take a look at the volatility that we have seen. Now, the price of nat gas is up 40% from those April lows. You can barely see it, though, because we're down 70% from the highs that we saw last August. Our next gas is not looking for a big bump in natural gas. For more, we're joined by David McAlvany, CEO and portfolio manager at McAlvany Financial. I think some people who are looking for a turn in nat gas maybe got a little bit excited yesterday that maybe things were not so bleak. How are you thinking about it?
You know, I'm certainly looking at it from a longer term perspective. So the 70–80% decline off of last year's peak numbers were in order. And clearly we got overdone on the upside with the hullabaloo relating to Russia and Ukraine. We've corrected those levels. $2 looked pretty attractive to us. So we positioned pretty well at $2. And so coming off of those levels, I think in the twos, it's a constructive place to be a buyer. You're looking at something that is absolutely critical in the energy transition. And so this is something that I think people easily and quickly forget. We want to move to solar, we want to move to wind, but we can't do that. Not without a significant period of time, 3, 5, 7 years of very, very required use of natural gas. So here we are with probably the most critical energy commodity, and I think $2 is a great range. $2 to $3 is a great range to be building positions. I
apologize. I sort of misconstrued your view. You are sort of bullish on natural gas here at these levels, and is that are you playing that through specific companies?
Yeah, I mean, certainly we like. We like a lot of U.S. production, and you know the differentials between the U.S. pricing and European and Asian pricing certainly provide some opportunities, and that's what we saw yesterday with a significant move higher in natural gas prices. But I think in the final analysis, it's the consistency of production here in the U.S. and it's our required energy uses that make it very attractive at these levels.
And those that argue against a meaningful move in natural gas will just point to, the huge stockpiles.
Oh, we have huge stockpiles. There's no doubt. I mean, I think from a supply and demand perspective, there's other commodities that are more interesting. And, we talk about copper, and that has an even more compelling supply and demand scenario. But I think, this is where pricing moves from one extreme to the other. And so if you're looking past the current supply and demand dynamic, again, this is where you would say we've moved from $10 to $2, 3 looks pretty attractive relative to 10, relative to 6, relative to 7. This is a place where you would want to build a position. And does that mean that we have a catalyst for growth? No. So clearly there's an overhang of supply, and that will remain the case for some time. But again, when do you buy? I prefer to buy when things are cheap than when they're expensive.
So let's talk about copper then. Since you mentioned it, how does it fit into that lens?
Yeah, CapEx in the space has been less than needed to keep up with the energy transition. And so we're dealing with sort of a massive demand component, which is sitting there ready. There's political will for us to move to greater electrification, and it simply can't be done without, a 5 or 10 times supply delivered to the market. And there is no ability to do that. So I think we're looking at a really interesting setup for copper for many years to come. And anytime it's weak, that's something that should be bought. So I think the bigger story in the immediate for copper is the under reserving, if you will, in China. And I think we're getting ready to see a significant push in terms of stimulus there. The economy is awful. We can't seem to see the consumer return post-COVID, and the government, being centrally planned, has a GDP target which they are determined to meet. So the quality of growth this year, I think, is going to be pretty trashy as they go back to infrastructure stimulus. And so I think copper is sort of in the catbird seat to see significant Chinese stimulus. And again, this is when you set a target in a command and control economy, you will get to it. The question is it quality growth, not quality growth? I think at this point they don't care. So they're back to the bad habits of stimulating growth, and in this case, infrastructure wins. And you've got a number of industrial commodities, copper being one of them. So that, to me, I think actually Chinese stimulus is a bigger catalyst for copper than sort of the green and energy transition story, which is clearly a long-term benefit.